Question 1. Which of the following is a characteristic of a fixed annuity? A. It allows the annuitant to invest in a variety of sub-accounts that may grow based on market performance. B. It provides a guaranteed income stream based on a fixed interest rate. C. It has a payout structure that is dependent on the performance of a stock market index. D. It provides tax-deferred growth but no guaranteed income. Answer. B. It provides a guaranteed income stream based on a fixed interest rate. Explanation. A fixed annuity guarantees the annuitant a fixed interest rate and a predictable, guaranteed income stream. The amount paid out does not depend on market performance. Option A describes variable annuities, which involve investment in sub-accounts that are subject to market risk. Option C refers to indexed annuities, where the returns are linked to a market index's performance. Option D describes the tax treatment of many annuities, but it doesn't reflect the fixed nature of the income stream of a fixed annuity. Question 2. Scenario-based. Mr. Thompson is 60 years old and is considering purchasing a deferred annuity. He plans to begin withdrawals at age 70, expecting to use the annuity for income during retirement. He is unsure about the type of annuity he should purchase. Which of the following is the most suitable recommendation for Mr. Thompson? A. A fixed annuity would be appropriate because it offers predictable income based on a guaranteed interest rate. B. A variable annuity would be best as it offers the potential for higher returns based on market performance. C. An immediate annuity is ideal as it provides income starting immediately, which is more suitable for his needs. D. An indexed annuity would be ideal as it combines the benefits of both fixed and variable annuities. Answer. A. A fixed annuity would be appropriate because it offers predictable income based on a guaranteed interest rate. Explanation. Mr. Thompson's goal is to use the annuity for income during retirement, beginning at age 70. A fixed annuity is the most suitable option because it guarantees predictable income and the safety of a fixed interest rate. Option B is incorrect because while a variable annuity has growth potential, it also exposes Mr. Thompson to market risk, which may not be ideal if he desires stability. Option C is incorrect because an immediate annuity would begin paying out immediately, but Mr. Thompson is not ready to start receiving income until age 70. Option D involves an indexed annuity, which links to market indices and includes market risk. This might not be appropriate for someone seeking a guaranteed income stream. Question 3. Which of the following statements regarding the taxation of annuity withdrawals is correct? A. Annuity withdrawals are always taxed as capital gains regardless of when they are taken. B. The tax treatment of annuity withdrawals is based on the FIFO first in, first out method, where the principal is taxed first. C. Annuity withdrawals are taxed as ordinary income, with the earnings portion being taxed first under the LIFO last in, first out method. D. Annuity withdrawals are taxed as ordinary income, with the entire withdrawal being subject to capital gains tax. Answer. C. Annuity withdrawals are taxed as ordinary income, with the earnings portion being taxed first under the LIFO last in, first out method. Explanation. Under the tax rules governing annuities, withdrawals are taxed under the LIFO method, where the earnings interest are withdrawn first and taxed as ordinary income. This means that the principal is not taxed until all the earnings have been withdrawn. Option A is incorrect because annuity withdrawals are not taxed as capital gains. They are taxed as ordinary income. Option B describes the FIFO method, which is not applicable to annuity withdrawals. Option D is incorrect because annuity withdrawals are not subject to capital gains tax but are taxed as ordinary income. Question 4. Which of the following is an essential feature of a variable annuity? A. It provides a guaranteed fixed interest rate regardless of market performance. B. It allows the annuitant to invest in a variety of sub-accounts that are typically tied to stocks, bonds, and mutual funds. C. It provides guaranteed income payments with no investment risk. D. It has a fixed payout structure based on a predetermined interest rate. Answer. B. It allows the annuitant to invest in a variety of sub-accounts that are typically tied to stocks, bonds, and mutual funds. Explanation. Variable annuities allow the annuitant to allocate premiums among various investment sub-accounts, which are often tied to different asset classes like stocks, bonds, or mutual funds. This provides the potential for greater returns, but also exposes the annuitant to market risk. Option A describes a fixed annuity, not a variable annuity. Option C is incorrect because variable annuities carry investment risk. Option D describes the characteristics of a fixed annuity, where the payout is based on a predetermined interest rate, unlike a variable annuity. Question 5. Scenario-based MS. Ramirez, age 65, is considering purchasing an annuity to provide her with income for her retirement years. She is particularly concerned about her ability to keep up with rising costs of living over the next few decades. Which of the following annuity riders would be most appropriate for her? A guaranteed minimum income benefit GMIB rider, which ensures a minimum income level regardless of market conditions. B, an inflation protection rider, which adjusts her payouts over time to keep pace with inflation. C, a death benefit rider, which ensures her beneficiaries will receive a lump sum payment upon her passing. D, a long-term care rider, which provides additional payouts if MS. Ramirez requires long-term care in the future. Answer B, an inflation protection rider, which adjusts her payouts over time to keep pace with inflation. Explanation. Since MS. Ramirez is concerned about rising costs of living, an inflation protection rider is the most appropriate choice. This rider adjusts annuity payouts over time to account for inflation, helping to maintain purchasing power. Option A is a GMIB rider, which guarantees a minimum income but does not specifically address inflation. Option C provides a death benefit to beneficiaries, but it does not address MS. Ramirez's concerns about living costs. Option D offers long-term care benefits, but this is not related to inflation protection or MS. Ramirez's primary concern of rising costs. Question 6. When an annuity is surrendered early, which of the following is typically the most significant financial consequence? A, the annuitant may face tax penalties for early withdrawals, but no other charges. B, a surrender charge is applied, reducing the value of the annuity. C, the annuitant receives the full value of the annuity, regardless of when it is surrendered. D, the annuitant may lose the ability to withdraw any funds until the end of the surrender period. Answer B, a surrender charge is applied, reducing the value of the annuity. Explanation. Early surrender of an annuity typically results in a surrender charge, which is a penalty fee that reduces the value of the annuity. These charges are designed to discourage early withdrawals and to help the insurance company recoup costs associated with the annuity. Option A is incorrect because while there may be tax penalties on early withdrawals, the surrender charge is often the primary consequence. Option C is incorrect because early surrender usually results in a reduction of the annuity's value due to surrender charges. Option D is incorrect because surrendering the annuity does not prevent the annuitant from withdrawing funds, it just may reduce the value due to the charges. Question 7. Which of the following best describes the role of mortality tables in the pricing of annuities? A. Mortality tables are used to calculate the expected number of years an annuitant will live, which directly impacts the annuity's payment amount. B. Mortality tables are used to calculate the total premium an annuitant will pay during the accumulation phase. C. Mortality tables determine the interest rate applied to the annuity during the payout period. D. Mortality tables are used to calculate how much of the annuity's earnings will be subject to tax. Answer A. Mortality tables are used to calculate the expected number of years an annuitant will live, which directly impacts the annuity's payment amount. Explanation. Mortality tables play a key role in annuity pricing by estimating the annuitant's life expectancy. The insurance company uses these tables to determine how long they are likely to make payouts, which helps to set the annuity payment amount. Option B is incorrect because the mortality table is not used to determine premiums during the accumulation phase, but rather to estimate the annuitant's lifespan. Option C is incorrect because the interest rate applied to the annuity is not determined by mortality tables, but rather by the type of annuity and investment performance. Option D is incorrect because mortality tables do not directly relate to tax calculations. They are used for determining life expectancy. Question 8. Which of the following is a key difference between immediate and deferred annuities? A. Immediate annuities begin payout immediately after the purchase, while deferred annuities begin payouts at a later date after a specified accumulation period. B. Immediate annuities have a fixed interest rate, while deferred annuities are tied to market performance. C. Immediate annuities provide income for a set number of years, while deferred annuities provide income for life. D. Immediate annuities require a larger initial premium than deferred annuities. Answer A. Immediate annuities begin payout immediately after the purchase, while deferred annuities begin payouts at a later date after a specified accumulation period. Explanation. The key difference between immediate and deferred annuities is the timing of the payout. Immediate annuities begin payouts immediately after purchase, typically within 1 year, while deferred annuities allow the annuitant to defer payouts to a later date, often after a specified accumulation phase. Option B is incorrect because both immediate and deferred annuities can have fixed or variable interest rates depending on the specific type. Option C is incorrect because both immediate and deferred annuities can be structured to provide income for life or for a set period of time depending on the contract. Option D is incorrect because the initial premium amount can vary depending on the annuity contract and there is no inherent rule that immediate annuities require larger premiums. Question 9. Which of the following factors is most critical in determining the suitability of an annuity for a client? A. The client's preference for a specific insurance company's brand. B. The client's current health status. C. The client's age, income needs, and risk tolerance. D. The client's desire for maximum flexibility in accessing their funds. Answer. C. The client's age, income needs, and risk tolerance. Explanation. Suitability standards for recommending an annuity require that the annuity align with the client's financial goals and needs, such as age, income requirements, and risk tolerance. An annuity should be chosen based on whether it meets the client's long-term objectives, including providing a predictable income stream and matching their risk tolerance. Option A is incorrect because the brand of the insurance company is not a critical factor in suitability. Option B is also not a determining factor in suitability unless the client has specific health concerns that require long-term care, but this is not the primary consideration. Option D is less important in determining suitability compared to matching the annuity to the client's overall financial needs and risk profile. Question 10. What is the primary purpose of a surrender charge in an annuity contract? A. To cover the insurance company's marketing and advertising costs. B. To protect the insurer from the costs of issuing the annuity. C. To guarantee the annuitant a fixed return on their investment. D. To penalize the annuitant for withdrawing funds before the contract's payout phase. Answer. B. To protect the insurer from the costs of issuing the annuity. Explanation. Surrender charges are primarily designed to protect the insurer from losing money if the annuitant withdraws funds early before the insurer has had a chance to fully recoup the costs associated with issuing the annuity. These charges help to ensure that the insurer can manage the financial risks associated with early surrenders. Option A is incorrect because surrender charges are not intended to cover marketing or advertising costs. Option C is incorrect because surrender charges do not guarantee returns on the investment. Option D is incorrect because while surrender charges penalize early withdrawals, the purpose is to protect the insurer from financial losses rather than to punish the annuitant. Question 11. Which of the following types of annuities is most likely to provide the highest potential return? A. Fixed annuity. B. Variable annuity. C. Immediate annuity. D. Deferred annuity with a fixed interest rate. Answer. B. Variable annuity. Explanation. A variable annuity allows the annuitant to invest in various sub-accounts, typically tied to stocks, bonds, or mutual funds, giving it the potential for higher returns based on the performance of these investments. Fixed annuities provide predictable returns, but their potential return is typically lower compared to variable annuities. Immediate and deferred annuities may also have fixed or variable components, but the return depends on the type of annuity chosen and the investment strategy. Question 12. Scenario-based. Mr. Thomas, age 55, is seeking a way to secure a steady income stream for his retirement but is concerned about the impact of inflation over time. Which annuity option would best meet his needs? A. A fixed annuity with guaranteed payouts for life. B. A variable annuity with an inflation protection rider. C. A life insurance policy with a cash value component. D. A single premium immediate annuity SPIA with a fixed payout structure. Answer. B. A variable annuity with an inflation protection rider. Explanation. Since Mr. Thomas is concerned about inflation, a variable annuity with an inflation protection rider is the most appropriate option. This rider adjusts payouts to keep up with inflation, ensuring that the purchasing power of the income stream remains intact. Option A provides guaranteed payouts but does not address inflation concerns. Option C describes life insurance, which doesn't provide a predictable income stream. Option D may provide fixed payouts, but it does not account for inflation. Question 13. Which of the following is a key advantage of an annuity over other retirement income options? A. An annuity provides a guaranteed income stream for a specified period or for life, regardless of market conditions. B. Annuities provide tax-deferred growth during the accumulation phase. C. Annuities do not have any surrender charges or penalties for early withdrawal. D. Annuities are generally less expensive than other retirement options like 401k or IRAs. Answer A. An annuity provides a guaranteed income stream for a specified period or for life, regardless of market conditions. Explanation. One of the key advantages of an annuity is the guaranteed income stream it provides, which can be structured for a set period or for life. This can offer peace of mind for individuals looking for stable retirement income. While B is also true for many annuities, the guarantee of income for life or a specified period is a distinct feature that other options, such as 401k or IRAs, may not offer. Option C is incorrect because annuities often have surrender charges for early withdrawals. Option D is not accurate since annuities can be more expensive due to fees and commissions. Question 14. Which of the following best describes the primary purpose of a death benefit rider in an annuity? A. To provide a lump sum payment to the annuitant's beneficiaries if the annuitant passes away before receiving the full amount of their annuity. B. To guarantee that the annuitant will receive the full value of their premium regardless of how long they live. C. To ensure that the annuitant will continue to receive income payments after their death. D. To cover the annuitant's burial expenses. Answer A. To provide a lump sum payment to the annuitant's beneficiaries if the annuitant passes away before receiving the full amount of their annuity. Explanation. A death benefit rider ensures that if the annuitant passes away before receiving the full amount of their annuity, their beneficiaries will receive a lump sum payment, usually equal to the premiums paid or the account value at the time of death. Option B is incorrect because the death benefit does not guarantee the return of the entire premium. Option C describes a continuation rider, not a death benefit. Option D is unrelated to the annuity's purpose. Question 15. In which of the following situations would an annuity be most beneficial? A. A client seeking to maximize short-term capital gains. B. A client looking for a way to guarantee income for life during retirement. C. A client wanting complete access to their principal at any time without penalty. D. A client seeking to purchase a home with the annuity proceeds. Answer B. A client looking for a way to guarantee income for life during retirement. Explanation. Annuities are particularly beneficial for individuals seeking a guaranteed income stream for life or a set period, making them ideal for retirement planning. Option A is incorrect because annuities are long-term products, not suitable for short-term capital gains. Option C is also incorrect because annuities typically have surrender charges for early withdrawals. Option D is not relevant because annuities are not typically used for large, immediate expenses like buying a home. Question 16. Which of the following is a potential disadvantage of a fixed annuity? A. The annuity payments are subject to market fluctuations. B. The annuitant is not guaranteed to receive a return on their investment. C. The annuity does not provide a predictable income stream. D. The purchasing power of the annuity payments can be eroded by inflation. Answer D. The purchasing power of the annuity payments can be eroded by inflation. Explanation. One disadvantage of fixed annuities is that their payouts are set at a fixed amount and may not keep up with inflation, leading to an erosion of purchasing power over time. Option A is incorrect because fixed annuities are not subject to market fluctuations. Option B is incorrect because fixed annuities guarantee a return typically at a fixed interest rate. Option C is incorrect because fixed annuities provide a predictable income stream. Question 17. What does a liquidity feature in an annuity allow an annuitant to do? A. Withdraw a portion of their funds without penalty at any time. B. Receive a larger payout during the accumulation phase. C. Access additional investment options during the payout phase. D. Cancel the annuity without surrender charges after a specified period. Answer A. Withdraw a portion of their funds without penalty at any time. Explanation. The liquidity feature of an annuity typically allows the annuitant to withdraw a portion of the funds without incurring a penalty subject to the contract's terms. This feature is most common in some variable annuities. Option B is incorrect because liquidity does not directly affect payouts during the accumulation phase. Option C is unrelated to liquidity. Option D is incorrect as cancellation without surrender charges is not part of the liquidity feature. Question 18. Which of the following is most likely to be a characteristic of a life annuity with a period certain feature? A. The annuitant receives guaranteed income for life, but the payments stop at the end of a predetermined period, regardless of the annuitant's survival. B. The annuitant's beneficiaries receive the remaining value of the annuity if the annuitant dies before the end of the predetermined period. C. The annuity payments stop after a set number of years even if the annuitant is still alive. D. The annuity guarantees a specific rate of return over the annuitant's lifetime. Answer: B. The annuitant's beneficiaries receive the remaining value of the annuity if the annuitant dies before the end of the predetermined period. Explanation: a life annuity with a period certain provides income for the annuitant's lifetime, but if the annuitant dies before the end of the period, the remaining payments go to the beneficiaries. Option A is incorrect because the payments would continue for the annuitant's lifetime, but would stop only if the annuitant survives the period. Option C is incorrect because the payments continue for life, not for a fixed period. Option D describes a guaranteed return, which is not the primary feature of a period certain annuity. Question 19. Which of the following types of annuities is most likely to have a payout that fluctuates based on market performance? A. Fixed annuity. B. Immediate annuity. C. Variable annuity. D. Indexed annuity. Answer: C. Variable annuity. Explanation: a variable annuity's payouts fluctuate based on the performance of the underlying investments, stocks, bonds, mutual funds, etc. This allows for the potential of higher returns, but also exposes the annuitant to market risk. Option A is incorrect because fixed annuities offer guaranteed, predictable payouts. Option B refers to the timing of payouts, not the investment risk. Option D refers to an indexed annuity, which provides a return linked to a stock market index, but typically has more limited upside potential than a variable annuity. Question 20. What is the primary advantage of a joint and survivor annuity? Option A ensures that the surviving spouse will continue to receive income after the annuitant's death. B. It guarantees that the annuitant will receive higher payments if the spouse dies first. C. It allows for income payments to stop immediately upon the annuitant's death. D. It offers a one-time lump sum payment to the surviving spouse after the annuitant's death. Answer A ensures that the surviving spouse will continue to receive income after the annuitant's death. Explanation: a joint and survivor annuity provides income to both the annuitant and their spouse. Upon the annuitant's death, the surviving spouse continues to receive a portion of the annuity income, ensuring they have continued financial support. This is a key advantage for couples who wish to ensure that the surviving spouse is not left without income. Option B is incorrect because the payments are typically lower to provide income for both parties, not higher. Option C is incorrect because the payments continue after the annuitant's death. Option D is incorrect because the joint and survivor option provides ongoing income, not a lump sum payment. Question 21. Which of the following is true regarding the taxation of annuity withdrawals? A. Withdrawals are taxed as capital gains. B. The first withdrawals are always tax-free due to the FIFO method. C. The withdrawals are taxed under the last in, first out LIFO method. D. Withdrawals are taxed under a tax-free method if the annuity is held for more than 5 years. Answer: C. The withdrawals are taxed under the last in, first out LIFO method. Explanation: annuity withdrawals are taxed on a last in, first out LIFO basis, meaning that the earnings, interest, and investment returns are withdrawn first and taxed as ordinary income. This makes them subject to higher taxes than withdrawals from the principal, which are typically not taxed unless the investment grows beyond the original premium paid. This prevents tax-free returns on investment gains and ensures the tax burden is placed on the earnings first. Options A, B, and D are incorrect because they refer to tax rules not applicable to annuities under standard tax treatment. Question 22. What is the primary difference between a fixed annuity and a variable annuity? A. Fixed annuities offer guaranteed returns, while variable annuities' returns depend on the performance of underlying investments. B. Fixed annuities allow for changes in the interest rate over time, while variable annuities do not. C. Fixed annuities require annual premiums, whereas variable annuities require lump sum payments only. D. Variable annuities guarantee a minimum payout regardless of the performance of underlying investments. Answer A. Fixed annuities offer guaranteed returns, while variable annuities' returns depend on the performance of underlying investments. Explanation: fixed annuities provide a guaranteed interest rate and fixed payouts for the life of the annuity. They offer stability and predictability, making them less risky for the annuitant. Variable annuities, on the other hand, allow the annuitant to invest in various sub-accounts that may include stocks, bonds, or other securities. The returns on A variable annuity depend on the performance of these investments, meaning the payouts can fluctuate. Option B is incorrect because fixed annuities do not allow for interest rate changes if they have a set rate. Option C is incorrect because both types can accept both lump sum and periodic payments. Option D is incorrect because variable annuities do not guarantee a minimum payout unless additional riders are purchased. Question 23. Mr. Reynolds is considering purchasing an annuity for retirement purposes. He wants to make sure the annuity fits his needs given his age of 68, expected retirement date in 2 years, and his moderate risk tolerance. Which should be Mr. Reynolds' primary consideration in choosing an annuity type? A. The annuity should offer a guaranteed income for life, ensuring income stability. B. The annuity should invest heavily in stocks to maximize growth potential before retirement. C. The annuity should be a variable annuity with high-risk sub-accounts to achieve large growth. D. The annuity should be a deferred annuity to delay withdrawals until after his retirement. Answer A. The annuity should offer a guaranteed income for life, ensuring income stability. Explanation. Given Mr. Reynolds' age, his imminent retirement, and moderate risk tolerance, he should prioritize an annuity that offers guaranteed income for life. A fixed annuity or a joint and survivor annuity option would provide him with the predictability and stability that aligns with his goal of ensuring income security in retirement. Option B and C are not suitable because they involve higher levels of risk which may not be appropriate for someone near retirement. Option D is less suitable because the deferred annuity delays income payments which may not be necessary with his retirement approaching soon. Question 24. What is the purpose of a surrender charge in an annuity contract? A. To ensure the annuitant does not withdraw funds prematurely, preserving the annuity's value. B. To provide the annuitant with a higher payout amount upon withdrawal. C. To protect the insurer against the risk of early withdrawals, depleting the contract's value. D. To guarantee a set minimum amount of income regardless of the withdrawal amount. Answer C. To protect the insurer against the risk of early withdrawals, depleting the contract's value. Explanation. A surrender charge is a fee that the insurer charges if the annuitant withdraws funds before the end of the surrender period. This helps protect the insurer from the financial risk associated with early withdrawals, which could deplete the funds in the contract before the annuitant reaches the desired payout period. Option A is partially correct in that it discourages premature withdrawals, but does not fully capture the insurer's financial protection. Options B and D are incorrect because the surrender charge does not directly impact the payout amount, but rather the availability of funds. Question 25. Which of the following is true regarding the Guaranteed Minimum Income Benefit (GMIB) rider? A. The GMIB rider guarantees a minimum income level based on the original premium. B. The GMIB rider ensures that the annuity will provide income for a fixed term only. C. The GMIB rider guarantees a death benefit to the beneficiary equal to the total premiums paid. D. The GMIB rider is designed to increase the annuity's payout as market conditions improve. Answer A. The GMIB rider guarantees a minimum income level based on the original premium. Explanation. The GMIB rider guarantees a minimum income level regardless of the performance of the underlying investments. This ensures the annuitant receives a minimum payout based on their original premium, offering a level of financial security if the investments underperform. Option B is incorrect because the GMIB focuses on income guarantees, not fixed term payouts. Option C is incorrect because death benefits are typically covered under separate riders. Option D is incorrect because the GMIB provides a guarantee, not an increase based on market performance. Question 26. What is a common risk associated with an indexed annuity? A. The annuity's value will decrease if the linked index experiences negative performance. B. The annuity will guarantee a fixed payout based on the annuitant's age. C. The annuity's payments are not subject to any market risk. D. The annuity's value is entirely dependent on stock market performance. Answer A. The annuity's value will decrease if the linked index experiences negative performance. Explanation. Indexed annuities are linked to a market index, such as the S&P 500, and their returns are affected by the performance of the index. While these annuities often have caps and floors, the value of the annuity can still decrease if the index performs poorly. Option B is incorrect because indexed annuities typically offer variable payouts based on index performance, not fixed payouts. Option C is incorrect because indexed annuities still carries a market risk. Option D is also incorrect because the value is influenced by the index, not entirely dependent on stock market performance. Question 27. Which of the following would be a potential disadvantage of purchasing a deferred annuity? A. It guarantees higher payouts as the annuitant's life expectancy increases. B. It may be subject to surrender charges if funds are withdrawn during the accumulation phase. C. It provides immediate income once the premium is paid. D. It offers tax-free growth during the accumulation phase. Answer B. It may be subject to surrender charges if funds are withdrawn during the accumulation phase. Explanation: deferred annuities have an accumulation phase where premiums grow tax-deferred before income payments begin. If the annuitant withdraws funds during this phase, they may face surrender charges, which can reduce the amount available for withdrawal. Option A is incorrect because deferred annuities do not automatically guarantee higher payouts based on life expectancy. Option C is incorrect because deferred annuities do not provide immediate income. They begin payouts at a later date. Option D is incorrect because although the annuity grows tax-deferred, this does not mean the growth is tax-free. Taxes are due when withdrawals are made. Question 20. Mr. and Mrs. Martinez are considering purchasing an annuity for their retirement, and they have two options: a fixed annuity or a variable annuity. Mr. Martinez is concerned about market risk, and Mrs. Martinez wants to have the opportunity for higher returns. Which option should they choose? A. Both should choose the fixed annuity for guaranteed income with no market risk. B. Mr. Martinez should choose the variable annuity, and Mrs. Martinez should choose the fixed annuity. C. They should choose the fixed annuity for predictable payouts and no market fluctuations. D. They should choose the variable annuity to potentially increase their returns, but understand the market risk. Answer D. They should choose the variable annuity to potentially increase their returns, but understand the market risk. Explanation: given Mr. Martinez's concern about market risk and Mrs. Martinez's desire for higher returns, a variable annuity might be the right choice. This type of annuity offers the potential for higher returns through investments in market subaccounts, but it also carries the risk of market fluctuations. Mr. Martinez, concerned about market risk, may still be comfortable with a portion of the annuity invested in safer options, such as fixed income subaccounts, while Mrs. Martinez could potentially benefit from higher returns by investing in riskier subaccounts tied to the stock market. However, it's important for both to understand that the returns of a variable annuity can fluctuate based on market performance. In contrast, the fixed annuity provides predictable, guaranteed payouts, but with generally low returns, which would not meet Mrs. Martinez's desire for high growth. Question 29. Which of the following is a characteristic of a single premium immediate annuity? Spear 8. The annuitant makes periodic payments over time, and the payout begins immediately after the last premium is paid. B. The annuitant makes a lump sum payment and the annuity begins paying out immediately. C. The annuitant pays premiums over several years and the payout begins after a predetermined waiting period. D. The annuitant receives payouts only at the end of the term of the contract. Answer B. The annuitant makes a lump sum payment and the annuity begins paying out immediately. Explanation: a single premium immediate annuity SPIA is designed to provide an immediate income stream after a lump sum payment is made. The annuitant pays a one-time premium and begins receiving regular payments immediately, making it an ideal option for individuals who need an income stream right away, such as retirees. Options A, C, and D are incorrect because they either involve ongoing payments or delayed payouts, which do not apply to the SPIA. Question 30. Which type of annuity provides a minimum income guarantee but also allows for participation in the potential growth of an underlying stock market index? A. Fixed annuity. B. Variable annuity. C. Indexed annuity. D. Immediate annuity. Answer C. Indexed annuity. Explanation: an indexed annuity combines the stability of a fixed annuity with the potential for growth linked to a stock market index, such as the S&P 500. While it offers a minimum guaranteed return, often based on a fixed rate or minimum floor, the annuitant can also participate in a portion of the upside of the index's performance. This makes it a good middle ground for individuals seeking both security and growth potential. Options A and B are incorrect because fixed annuities offer only guaranteed returns, while variable annuities rely entirely on market performance without a guaranteed minimum. Option D is incorrect because immediate annuities provide guaranteed income but do not offer growth linked to market indices.